All right, the Fed less than 24 hours away from its next interest rate decision, and our next guest sees more than just one more hike ahead. Market researcher Jim Bianco runs Bianco Research. He joins us now. Jim, it's always great to see you. Is this what Jerome Powell is going to forecast or telegraph at the press conference tomorrow, that there is one more hike in your view?
Well, they did forecast that at the last press conference. Remember, they put out their dot chart that said that there'd be 2 more hikes this year. We're going to get one tomorrow. I know, but they haven't believed him. They haven't believed him this whole cycle, and they've been wrong this whole cycle to continuously underestimate his resolve in raising interest rates. So we're going to get one tomorrow. And, whether or not we get one more after this, the market's putting about a 1/3 chance that we're going to put another one in, and we'll find out tomorrow. Now, I think what we're going to find is that the inflation rate is going to be problematic. It's 3% now. It's probably going to drift a little bit higher, maybe towards 4, not 9 or 10. But that'll be enough for the Fed to say, maybe we're not quite done just yet, and there could be at least one more rate hike done. And then after that, the whole idea that the Fed would declare victory and then start cutting rates next year, I don't think that will happen. The last 3 rate cutting cycles occurred because the Fed was panicking we were going into a recession. And it makes it about the worst time to own stocks. Now, they're not cutting rates now, but if they are to follow that precept, they're not going to start cutting rates till things go bad, whether that's next year or 5 years from now. But they're not going to declare victory and probably cut rates anytime next year. So more rate hikes, and then we hold at that higher level.
Jim, I agree with you. No rate cuts. The market clearly saying you're going to see a rate cut in the first couple of months of next year. I mean, I think that's what's being priced in. So with that said, if you're right, how expensive is the stock market here, and what kind of haircut should we be looking at?
Well, if I'm right in that, rates are going to continue to drift higher, and that the 10-year note, is probably going to look at something with a 4 handle or a high 4 handle, 4.5% to 5% over time for those rates, that's going to provide heady competition for the stock market. Look, the long-term measures say that the stock market should return around 9%. If you can get 5.5 on a money market fund, and you can get 5 in a 10-year bond, and the potential of capital appreciation should rates fall, TINA is no longer available. And that will probably give the stock market some real problems as we move forward. Now, it's not going to crash or anything like that. But the thing about it is, when people elect to say, I don't want to play in the stock market, they're being rewarded for it right now. It's not 2019 where when you elected not to play, you were getting 0. You're getting half to 2/3 of the return of the stock market with a lot less risk.
Hey, Jim, you just said that, the last couple rate cutting cycles had been the Fed panicking because of a recession. Do you think that there's a new regime now? Will they not panic? Will they not look to cut so aggressively if they start seeing economic weakness after such an aggressive period of hiking over the last year and a half?
The last time the Fed declared victory and cut rates was 1995. The stock market was up 40% over the next year, and then Greenspan started using the words irrational exuberance in 1996 because things got out of hand. Now the Fed's going to probably look at what the stock market's done in the first half of this year and say, I don't want to feed another 1995 type of bubble. So I don't think that they're going to be looking to feed that kind of bubble. Now, that doesn't mean that they're going to have to continue to raise rates. They're just not going to acquiesce, I think, in cutting rates anytime soon. Besides, you could also turn it around and say, we're still producing 200,000 jobs a year. We're still producing positive GDP. Where is the damage from those higher rates? I know people like to say that there's going to be damage, and we've perpetually said there's going to be a recession 6 months out, for now a year and a half. But until that actually materializes, there really is no reason for the Fed to cut rates.
Jim, good to see you. Jim Bianco, Bianco Research.
Thank you.